Hi, this is Jim Curzan, and welcome to another edition of our Capital Market Review. This information will cover everything current through the third quarter of 2019. And as always, the information discussed herein is that of myself, Jim Curzan, and not that of Raymond James or any of its affiliates. As I do every quarter, we come up with a theme, and the theme today is 2020 Vision Distorted. You know, this will be the last capital market review for this decade. When you hear me again for the next capital market review, it'll be 2020 and the start of a brand new decade. So 2020 is important in that regard, but it's also important as it relates to vision. Occasionally, I wear glasses, and by wearing glasses, I'm constantly keeping my lens clean. It seems like it always gets smudged with something. Today, as investors and savers, there's a lot of smudging going on when we think about all the distortions that we have to deal with respect to the political climate, Russia, Trump's impeachment, China, as well as where we are in the economy. So in an effort to provide better vision, not only for 2020, but rather the 20s, we're going to discuss much of the economic data that is current and available to us today. As always, the economy matters, and our effort is to attempt to dissect several major components of the economy. We're going to talk about growth as it relates to corporate earnings, the job market, corporate profits, inflation, and also interest rates as it relates to the Federal Reserve. It is our attempt to answer where we are and, more importantly, where we're heading. In our practice, as we allocate assets on behalf of our clients, we try to have two very strong opinions. One is on where we think we are in this economic cycle, and two, where the Fed is, and more likely where the Fed is going. If we get those two things right, the rest of the allocation, as far as we're concerned, is much, much easier. And today, we're at that key pivotal point. Data is still growing. Data is still advancing. The economy is still moving forward. But it is moving forward at a somewhat slower rate. So we're trying to determine whether we're still in a slow growth economy or whether we may very well have entered into an economic slowdown. Now, an economic slowdown doesn't necessarily mean a bad market. In fact, in many cases, stock markets have done just fine during economic slowdowns. But our opinion on that will certainly drive forward-looking allocations. For today's agenda, we're going to discuss 5 key elements. We're going to first take a look at the short-term economic outlook. Take a look at where we are. Are we going to enter into a recession, or will the economy continue to grow at least through 2020? We'll also take a look at the long-term economic outlook and why perhaps inflation is as low as it is and why it may continue to stay low for a while. We'll also touch on overseas climates and how what's happening there is impacting their central banks and what that does to global economic growth. And we couldn't have a quarterly capital market review without discussing pre-election political risks. What does this all look like? And what would happen if there was a change in Washington? And what impact might that have on the economy? And then lastly, we'll take a look at asset classes and valuations. Are there things still today that seem somewhat cheap? And more importantly, why a sound strategy generally involves broad-based diversification. Let's start with the economic outlook. And here we'll walk through both the short-term, long-term, and global aspects. Let's start our discussion by looking at economic growth. This is an interesting chart, the one on the left, as it discusses economic growth over the last 60 years. Recently, we'll see that our year-over-year economic growth was about 2.3%. Quarter over quarter, about 2%. That 2% number is a bit under the near-term trend. So things are still advancing, but advancing at a bit slower rate. The growth in GDP, or the lack thereof, has much less to do with consumer confidence. It really has more to do with business confidence. Because of the political climate and some uncertainty there, businesses are holding back on capital investment. In fact, if we look at the right-hand side components of GDP, you'll see investment ex housing, that's corporate business demand, is actually a little bit slower, a little bit less than it normally would be. And that's where we're beginning to see a little bit of slowdown. If you think about it, recessions don't start with massive layoffs. Massive layoffs are really a function of a weak economic environment, and that usually happens sometime through a recession. Recessions usually start when businesses elect not to fill positions. They start when hiring slows down. So we have to watch those numbers very closely. We look at those numbers weekly at our firm. This chart on business sentiment kind of elaborates on my last comment regarding hiring. It shows hires versus layoffs. So the gray line that you see really represents layoffs or discharges. The blue line represents hires. And the gray bar kind of running down the middle of that left-hand slide is a recession. And if you notice on the blue line, you start to see a downward drift before we actually enter into a recession. Hiring slows up. Layoffs, or massive layoffs, tend to happen well into a recession. So business sentiment is really important, and we have to watch that as it relates to the political climate as we move forward and certainly into 2020. The chart on the right talks about policy uncertainty and capital spending. A way to explain this is simply when there's a high degree of uncertainty, companies simply don't do anything, and you don't see a lot of capital spending. And if you just kind of look at the various years and the years we know, as an example, the Great Recession, you'll see a huge reduction in capital spending before we actually got into a recession. This chart on cyclical sectors might actually be a chart that would suggest we won't see a recession anytime soon. These are the four big horsemen of the economic apocalypse. When these are turning south and doing poorly, the economy tends to wane and lose steam. The four are residential investment, or individual investment, folks, as a function of GDP. Business investment inventory, or businesses actually building and plants and equipment and capacity. Vehicle sales, and then private inventory, which is housing inventory. If you look at these charts, they're to a large degree at trend, or in many cases well below trend. They're not by any means showing monstrous growth. And if you think about it, recessions typically happen as a result of a way of controlling excesses that have built up in the economy. And these four charts suggest that there really isn't a whole lot of excess out there. There isn't a whole lot of bubble here to let air out of. So that might indicate that an economy may continue to drift along at a slow growth rate for quite a while still to come. Another reason the economy might continue to limp along has to do with consumer confidence. This is kind of an interesting slide. There's a lot going on. It was compiled by Pew Research, and what it did is it asked Americans how they feel about the economy. Do they think the economy is good? Is it neutral, or is it poor? And then they also at the same time asked their political affiliation. So you'll see the Republicans are represented by red. The total subset of those interviewed was gray. And then the blue would be those that identify themselves as Democrats. And if we just look at certain years here first, and then we'll go back, Obviously, in 2000, just before the dot-com bubble, everybody thought the market was doing really, really well. There was certainly a collective opinion on what that looked like. And one can also look at 2008 going into 2009, and to a large degree, there was no argument that things were really pretty bad. But look at either the period of time immediately before that, 2008, we'll call that the Bush administration, and we'll look at things after 2009, which we'll call the Obama administration. Here, you see a lot of polarity. Here, the Republicans thought Bush was doing great, the economy was doing wonderful, and Democrats, to a large degree, thought there was a huge, huge problem. And conversely, under the Obama administration, after the financial crisis, Republicans weren't too keen on what was going on, yet the Democrats thought things were improving quite a bit. And today, we still have that huge separation as well, where Republicans think things are great and Democrats not so much. What this suggests is because of the polarity in our political system and here in the country, there's not a huge amount of the population that believes things are really great. Even today, consumer confidence, while it's strong, isn't overwhelmingly strong. There's a huge amount of population that isn't so sure, and that also takes a ton of excess out of the equation. It reduces the potential for a big bubble. It also tells me that it's probably not a good idea to let your political feelings get interwoven in terms of your investment and economic decisions. What it tells me is under the Bush administration, which, by the way, we had some incredibly strong years, there were an awful lot of Democrats that missed out on opportunity. And conversely, under the Obama administration, I'm willing to bet a lot of Republicans sat on a lot of cash and didn't participate in a good deal of this 10-year bull market. They only got engaged after the 2016 election. So as a result, this chart would suggest that maybe the economy isn't quite bubblish yet, and that's a good thing. This chart shows the long-term drivers of economic growth, and they tend to be the growth in the workforce, the number of workers, plus the growth in productivity. Up at the very top, growth in worker age. We see that we have a problem. The population growth as it relates to the U.S. continues to drop off. Part of that is subdued birth rate, but the other thing is a questionable immigration policy. Typically, we would look for at least 1 million new immigrants with a skill set each and every year. And immigrants coming in have a bigger positive impact on GDP than homegrown workers. Bringing in somebody with a PhD who's 35 years old, who's studied here under a visa, versus popping out into the workforce a brand new 18-year-old worker, the 35-year-old will have the ability to contribute much more and is much more productive. So that's a problem. As the workforce shrinks, the size of the number of workers shrink, which has a direct impact on GDP growth. We will also see that on the right-hand side. On the right-hand side, we're looking at both of those components. And sadly, if we look at kind of where we are now over the last 10 years, by the way, the gray bar is growth in output or productivity. The blue bar is number of workers. And you'll see, because of some questionable immigration policy at this point, this decade, we've generally had a lower growth rate in workers for a variety of reasons. And the other thing is productivity per worker is dropping a bit as well. We just don't have or haven't had a brand new earth-shaking technology. When you go back to 89 to 98, we transitioned to desktop computers, and we had laptop computers, and productivity took off. Productivity per worker was nearly 2% a year versus just above 1% today. So what this is telling me is generally it's very difficult to maintain 3+% GDP growth where we are today. Could that happen? Sure. It's either going to happen because of a change in immigration policy, an increase in birth rate, or an increase in productivity because of something that has been created that has a huge application among workers. It also indicates that with fairly low GDP growth, we should expect somewhat low inflation, lower longer. To continue the discussion on employment and workers, this chart talks about the unemployment rate and wages. You'll see it's somewhat a mirror image. When we get very, very low unemployment, when there's not a ton of people looking for work, we generally have to pay up to bring workers into a particular business because you're typically bringing them in from a fully employed position elsewhere. Looking at the chart, I would venture to say that the unemployment rate probably isn't going to get a whole lot lower than it is today. In fact, it may very well tick up over the course of the next year a bit. And I really don't expect to see a huge move beyond the move we've had in wage growth either. In fact, the inflation rate is actually a bit more benign this year than it was last year. And that certainly has impacted across the board wage rates and wage increases. Talking about inflation, this slide again shows how low inflation is relative to its long-term trend. As of the last reporting before this webinar, which would have been August, the headline or CPI headline inflation was only about 1.8. The core PCE, which is what the Fed looks at, was also 1.8. That number is about the same as it was in July, and it's certainly well beneath trend. Part of the reason for that is a huge drop in energy cost. Food, fairly flat. Core CPI ticked up a little bit. Generally, the energy number is really wishy-washy. It'll bounce around quite a bit quarter over quarter. So if we looked at core and we had any takeaway at all, we'll say it's tracking up a little bit, but not a whole lot. Certainly nothing here that would be problematic, and nothing here that would imply that inflation is a problem that the Federal Reserve would have to get involved in. Continuing on the subject of inflation and why inflation may remain low for a while, this is interesting. I've seen a number of economic slide decks include this slide or some slide similar based on the data from labor statistics. Let's look at the left-hand side first. This represents the top 10% of pre-tax national income. And we can see right now that if you look at income share, the top 10% of folks represent about 50% of national income. Now that number is up quite a bit from about 38% or so, let's say in the year 1990. So over the last 20 years or so, the top 10% of wage earners have wages that represent now 50% of all wages. And the reason that this is important as it relates to inflation, it might very well be another reason why we don't see a ton of inflation. And you can see that because of this wage disparity, a lot of wealth is in fewer hands than before. And you'll see a lot of discussion about this come next year with the political campaigns. The right-hand slide talks about spending as it relates to where you are in this decile. Are you a top 10% wage earner? Are you a bottom 90% wage earner, or bottom 10%, another way of saying that? And what it says is the top wage earners spend a whole lot less of their money as it relates to their income. And bottom wage earners spend everything. And because there's so much disparity, we're not seeing a ton of inflation because people with money want to save. People that want to spend don't have the money to spend. So you don't have a lot of traditional inflation definition, which is a whole lot of money chasing too few goods. And on a national basis, this tends to suppress inflation. So we'll see if this changes at all as the nation attempts to create some degree of wage or wealth parity, however that tends to work. But right now, there is somewhat of a cap on a lot of big ticket discretionary income items. Now let's take a look at the rest of the world. This is a PMI chart. It's a hot chart. It talks about manufacturing activity. Positive manufacturing activity would indicate a PMI number of 50. Anything above 50 means you've got growth in the manufacturing sector. And anything below 50 would imply some type of contraction. And the chart is red, yellow, green. Green is good. That means we're way above 50. Yellow is a lot closer to that 50 number, and red is certainly sub 50. The way it looks is you've got all the developed countries up near the top of the chart, and you have many of the emerging markets near the bottom of the chart. A lot has changed over the course of the last year. Over the course of the last year, 2018, most developed countries were showing very strong manufacturing. And again, I should add here in the U.S., consumer spending is much more important, consumer confidence, than the manufacturing sector per se. But that's not the case elsewhere. And now today, there's some intrepidation. There certainly is less, the manufacturing sector is less robust, I should say, than it was. And you're actually seeing some countries like Germany actually dipping into negative numbers. A lot of this has to do with worry and concern about tariff and trade issues. And I would expect that some of this may very well improve if we get better clarity on that particular subject. Speaking of trade, this chart will show a couple of interesting data points. First, in the upper left-hand corner, worldwide trade volume. Not a surprise, worldwide trade has dipped here a bit. Certainly it's now tracking below long-term average. We're just a year ago or so, before tariff and trade issues, we were certainly tracking at or near the long-term trend. On the right-hand side, we see exports as a percentage of GDP. Another way of saying that is when you look at a country's GDP, just how much of the stuff they make do they sell abroad and how much of the stuff is actually used within the country. And you'll see about the middle to bottom U.S., the smallest number on the board, 8%. Meaning when we look at our GDP, as big as it is, only about 8% of our GDP has to do with us exporting. We make and consume and sell to ourselves just about everything we manufacture. That's quite a bit different with respect to other countries. China's nearly 20%. Taiwan is nearly 60%. So what this means is when we're dealing with tariff and trade issues, it doesn't hurt us nearly as much as it hurts others because we make and sell most of our stuff here. And that's one of the reasons that at the end of the day, this trade and tariff issue with China will impact China. It will hurt China more. The question is, do we have staying power, and what long-term effect does it have on certain sectors of our economy? And this issue of trade has had a big impact on many countries' central banks. On the right-hand side, we see the number of rate changes by the top 10 central banks throughout the world. In 2018, before tariff and trade issues became a real thing, we primarily saw rate hikes. Certainly, we were raising our rates here. And then in 19, we've actually had more cuts than hikes. On the left-hand side, you can see that a bit more graphically, depending on the actual central bank, whether it's the ECB, which controls the Eurozone, Bank of England, Bank of Japan, or the Federal Reserve. It's interesting that going into 2000, there's still an expectation of having several central banks continue to cut rates. But rates today are about across the board as low as they've ever been. And the reason for that is today we actually have several central banks that actually have established negative yield, negative interest rates. And that's affecting the strength of the U.S. dollar. As of recently, a 10-year U.S. Treasury was priced to yield 1.6%. A 10-year Deutsche Mark bond would be priced to yield negative 0.8%. So what was happening if you were a saver in Germany, you would simply take your euros, convert to U.S. dollars, and buy treasuries. And that's created a huge demand for the U.S. dollar. The dollar has risen, and that becomes somewhat of a problem as well for our economy, as whatever little bit of exports we do have, they become even less competitive because they become very expensive compared to the local currency. This chart actually talks about what's happening with our central bank, the Federal Reserve. The chart shows all the price movements that the Federal Reserve has had over many years. And most recently, if we look to the far right-hand side of the chart, you'll see kind of the stair-stepped upward movement. Those were all the rate hikes that we had going back to 2015-16, right up through earlier last year. And then the 2 or so rate cuts that we've had year to date. Looking at predictions, both the Federal Reserve's Open Market Committee predictions or estimates, which is the blue dotted line that goes beyond where rates are today, the expectation is over the next couple of years, rates may go back up a bit, effectively taking back some of the cuts we've had. So out there, 2021, 2022, we might actually have a Federal Reserve rate that's pretty close to where we were at its peak, which was 2018. What's interesting is there's a huge dislocation between the Fed Open Market Committee and what the bond market is expecting. As of mid-September, the expectation is we will see lower and lower rates. I think the reason for that is the market might be betting on parity with the international markets, because the international markets, as I said, have in many cases negative interest rates or interest rates nearly zero. The thought is maybe to drag rates down further. I would hope the Fed doesn't, because by doing that, they're spending a lot of their tools now, and there might not be as many tools in the toolbox should we actually wind up in a recession and need Feds to cut beyond. Also, there are a whole slew of potential issues and problems with carrying a negative yield for an extended period of time. Some of that can lead into a lack of consumer confidence. But again, don't expect that to be the case. The Fed certainly isn't anticipating that, but that's another data point that we look at very closely. Let's spend a few moments talking about political risk. And we can kind of break this conversation up into current issues and then future issues, those being perhaps after the election. And again, these are things that are beginning to weigh on business confidence, not quite weighing on consumer confidence at this point. First, trade war. The expectation that a solution will be put forth is not really being reflected in the market today. In fact, we're noticing now, a year into this dialogue, that news of concerning trade or concerning an escalation in trade war is not quite having the same impact on the market as it did a year ago. A year ago, it seemed like any time it looked like we were closer to a deal, the market would be extremely euphoric, you see a big, huge run-up. And then any time a meeting was canceled, things were delayed, they walked away without some concrete, definitive solution, the market would sell off for several days in a row. Today, you might get a soft day or a soft half day or a good half day as a result of that type of news. So I think we're all feeling like it's going to be a much, much longer term negotiation. And the surprise factor is if something does happen, I don't think a lot of that has been priced in to the market. A lot of negative has already been priced in. So that's something that could be of a risk, but in this case, a kind of a positive. Immigration policy is something that we clearly have to deal with. For us to maintain a 2+% GDP growth rate, which would be targeted, we really need worker growth. We need the size of the workforce to increase. And historically, immigration has been a big reason for that. So I hope at some point we draft something that will help. By the way, that is not factored into the market either. Concerning future risks, almost all of those are political in nature. And I don't want to sound like I'm offering my political opinion. I certainly believe that under the current environment, well, let's put it this way, markets don't like a lot of change. Markets don't like uncertainty. And they would rather keep what is known than to venture off with the unknown. And I think because of that, a Trump reelection would be somewhat viewed as positive for the market. A Democratic win, especially some candidate who might be far left-wing, would cause a lot of concern and certainly would challenge business confidence. I mean, imagine some of the concerns that there would be. If you're a corporation and you've just enjoyed the last 2 years a 21% corporate tax rate as opposed to a 35% tax rate, what do you think happens in terms of planning for capital and expenditure and improvement if faced with now a 35% tax rate again? What happens to the market in that regard? Today, the market is fully priced at about 15.5 times earnings. If we went to a 35% tax bracket, that would take the PE up to 20 or 20.5, which would make the market immediately pretty expensive. And we would see more than likely some type of an adjustment. It obviously, another reason the market is done as well as it has, beyond the scope of taxes, is that for many industries, some of the burdensome regulations have been lifted or reduced or modified. And the expectation is we might see bigger government, which would have its own series of challenges. So at this point, we're staying the course. At this point, we're watching intently on what's happening in the political environment. We're certainly not making adjustments to the portfolio based on political news flow, but these are certainly things that we'll need to discuss, strategies that we will need to develop as we move into next year. For the final point with the agenda, let's now discuss asset classes and valuations. The first asset class we'll take a look at are bonds and how fixed income plays a part in the portfolio today. I'd mentioned that interest rates more than likely are not going to move a whole lot here. We don't expect them to drop significantly. We don't expect them to rise significantly. If they rise at all on the short term, they may rise back to where we were before we started the Fed cutting rates just recently. So over the next year or two, rates probably aren't going to move a whole lot. That's important because we don't expect long-term rates to move. Everything that's been moving has been really in the short-term environment. So when we look at this chart and we look at the data on the right-hand side, which is impact of a 1% fall in interest rates, how does that impact certain bonds of certain durations? You'll see as we get into a short-term environment, a 1% drop in rates might move a bond 2% to 3% in terms of total return. Obviously, for longer-term bonds, we certainly would expect a 1% drop. They have a much bigger impact on total return. We've already gotten a huge drop, so we don't expect to see that type of participation going forward. So if we look at the left-hand side, you'll kind of see where current yields are through the end of the quarter. 2-year bond, just over 1.6. 5-year bond, about 1.55. The yield curve 2.5 was inverted. The yield curve 2.10 was also inverted. You'll see it's very flat. The yield going out 1, 5, 10 years, you're within tenths of a percent of each other. So the takeaway on this is bonds serve a purpose. We're not expecting a huge amount of price appreciation. If you're a bond investor, you're barely making, well, under current yield, if you're a bond investor, you're not even covering the inflation rate, let alone the inflation rate and taxes. So bonds serve a purpose in portfolios today, but they're really kind of an anchor or a drag on portfolio performance. They're really there as an insurance policy. If something were to go wrong with the market, if something were to go wrong with the economy, they hold their value and increase their value because the Fed hopefully would respond by cutting rates. Again, that's one of the concerns I have with them cutting rates today. Just how much rate cutting will they be able to do when we need it? So at this point, bonds won't provide a lot of return for us. They will provide some protection. I look at it as an insurance policy. Now turning to the stock market, let's look at the S&P 500 as a benchmark representation of the market. What's interesting here is, or the takeaway I should say, is the market's pretty fully priced. In some areas it might be a little bit expensive. In most areas it is just at or maybe just above long-term trend. Really, there's only one data point that would suggest the market is still somewhat cheap and has a ways to go. If we look at the chart as it relates to the 25-year average, you'll see that forward-looking P's are a little bit rich, a little bit more expensive than the trend at 16.8 versus 16.2. The cap rate, or cyclically adjusted PE, is 29, and that's just a little bit above the 25-year trend. Dividend yield is a little bit less, so prices are high, yields are low. Price to book's a little bit more expensive, and price to cash flow is somewhat rich, certainly compared to long-term trend. The only thing that looks cheap right now is what we would call earnings yield, which is kind of the inverse PE, and we compare that to BAA or investment grade bonds. That yield is positive, which means you're basically making more on earnings yield than you are on a comparable investment grade bond. Historically, that number has been somewhat negative, and it's above 2%, which would imply that with that particular parameter, the market, the S&P, as it's still kicking out earnings, is somewhat cheap and might have a ways to go. Looking at the S&P in a bit more detail, let's take a look at the industrial sectors that make up the S&P. A couple of things you'll notice. Just about every sector is up this year. The two weak links tend to be energy and healthcare, both up single digits, when just about everything else is up double digits. I think a lot of that might have something to do with confidence in the sector as it relates to the political environment. Politicians these days are talking about carbon credits and eliminating fossil fuels, etc. And at the same time, they're talking about capping drug prices, reducing or eliminating certain patent protection, etc. And going to a one-payer system, all of which somewhat can contract potential growth and cause some fear in the sector. Looking at sectors that are cheap or cheaper, energy and financials look somewhat inexpensive compared to their 25-year, or I should say 20-year trailing PE. Today, both are trading a bit beneath long-term trend. And that's somewhat interesting. I think because of some uncertainty with the economy and the fact that they're both cyclicals, there might be a little bit of a cyclical premium put on those. And should the economy do fine going into next year and beyond the election, there might be an opportunity for those to kind of reverse back toward mean, which would improve the stock performances significantly, as there would be an expansion in the multiple. The international securities are very cheap compared to the U.S. Since the recovery started March 9th, 2009, the S&P is up 340%, although it wasn't straight up. There have been some zigs and zags along the way. And over the exact same period of time, starting the exact same day, the international markets are up about 107%. When you look at the international markets, they do offer a long-term compelling story. PEs are significantly lower than the U.S. Dividend yields are generally quite a bit higher than the U.S. and historically have been so. While the PEs tend to be less for international than U.S., they're actually beneath their long-term trend. And over time, there tends to be some reversion to the mean. If the U.S. is outperforming for an extended period, at some point it will cool off and the internationals take charge, and vice versa. I think one of the reasons for the lack of performance or underperformance this year has something to do with the strength of the U.S. dollar. The expectation is the dollar won't stay this high for long or forever. And a lot of what the Federal Reserve is doing today in terms of cutting rates is on an effort to reduce some of the dollar's strength. They haven't been totally able to do that, as in the past, a cut would be met with a cut in the Eurozone, or in the case of China, a devaluation of the yuan. But we're beginning to see a little bit of weakness there. And it's not a surprise that if you look over the last month, you'll notice that the international markets, or at least we're noticing that the international markets are actually outperforming the U.S. over the last several weeks. Certainly not over the year, but this may very well be the beginning of some type of a trend. In our balanced portfolios, we carry international exposure and have. The international exposure we have, though, is what we would consider underweight compared to what we would normally have. If this trend is visible and it continues, we will probably increase our international weighting compared to where we are today. More on that, I suppose, later. And lastly, a slide on allocation. We find it's almost impossible to invest by simply trying to place bets on what we think are the hot areas. Things change. Things that are hot today become cold tomorrow, and vice versa. But a more balanced approach, a more globally balanced approach, certainly makes good sense, provides significant staying power. And staying power by simply not having significant swings in capital. Yes, the account can go down, but it won't go down nearly as much, potentially, as it would if you were in a very hot category, very expensive category. So our approach has always been, for retirees, a more balanced global approach to portfolio management. And it seems to have served the accounts well over time. As we're winding down this quarter's capital market review, I just wanted to again remind you, hey, we're a growing firm. We have 14 individuals now that work here at Kaydan Wealth, and we would love to be able to provide a second opinion to any of your friends, colleagues, anybody at all who might like to get a better understanding of kind of where they are and what a relationship with Kaydan Wealth Management might look like. So please let us know if we can help in any way. We offer a very elegant investment process. We call it our evolutionary wealth process. Starts with our discovery interview, where we get a better understanding of goals and expectations and assets and resources. A clarity meeting, which provides clarity on where they are in the retirement process, how well they're positioned for a successful retirement. We do that through our trademarked retirement readiness report. And we also give them a clear understanding of what working with us would look like. If there's interest, we follow up with a mutual commitment meeting, and then we work through our development and completion meetings to develop our advanced plan and set the groundwork for all the other dialogues that we need to have in fairly short order. And then our maintain discipline meetings are the annual or semi-annual meetings that we have regularly to make sure that we're on pace, to inform them of performance, and also see if there's anything else that happened in their life that would cause us to want to modify the plan in any way. And as always, if you have any questions about anything I've mentioned, anything you've read, anything that you've discussed with a friend or family member, by all means, just reach out. Shoot me an email, give us a call. We're here, 14 people strong, willing to help and provide any assistance we can on any questions or issues you might have. With that, I want to thank you again for spending some time with me this quarter. Have a wonderful holiday season, and we'll certainly talk again in January when we record our capital market review for the fourth quarter of the year.